Welcome to the Deep Dive. Today, we're giving you a shortcut, really cutting through the noise to understand the key pivots happening right now. We're talking global markets, labor, and those tech supply chains that are driving everything. If you just look at the headlines, the mood seems, pretty firm. Major indices are up, it's risk on, crypto's stabilizing, and, well, everyone's expecting rate cuts.
But that's just the surface.
Exactly. It's what's happening underneath that we're digging into today.
That's right. And we've gone through a whole stack of sources that point to three, I think, really big interconnected shifts. First, we're going to look at what's really driving inflation. And, well, here's a hint. It's not tariffs. It's more about climate.
Interesting.
Second, there's this really abrupt shift in the labor market that's basically dictating Fed policy now. And third, the AI chip wars, just the explosive dynamics there.
So our goal for you, the listener, is to help connect all these seemingly separate dots.
Exactly. We're going to track the money, from something as strange as global spice prices all the way up to NVIDIA's pricing power. By the end of this deep dive, you should have a much clearer picture of where capital is really moving.
Okay, let's start with that first one, the backbone of the economy, the labor market. Because that's where the pivot feels most, immediate. The latest data is it's stark. We're looking at the new report from ADP.
The payroll giant.
Right, they process paychecks for millions of people, so their data is very current. And it's signaling that private sector payrolls are now actually contracting.
And the speed is what's really key here. It's the speed of the slowdown.
How fast are we talking?
Well, weekly job losses, they've just jumped. I mean, they went from an average of about 2,500 a week to 13,500.
Wow.
Yeah, it's a huge spike. And it matters so much because the official government data, from the Bureau of Labor Statistics, that stuff lags.
It's always looking in the rearview mirror.
It is. ADP's data is much fresher. So when you see payrolls contracting this fast, it's a forward-looking signal. And it basically forces the Fed to lock in expectations for a cut, probably at that December meeting.
Okay, so on one hand, we have a labor market that's softening and fast.
Yeah.
That implies, less consumer spending power.
Mm-hmm.
But on the other hand, retailers are gearing up for what everyone is saying will be the most promotional, discount-heavy holiday season in years.
And that's the collision, right? That's the question for you to think about. If the consumer is pulling back because of job worries, but the stores are full of inventory and competing hard on price, where does that pressure go?
Does all the discounting save us from a hard landing?
Maybe. But the speed of these job losses, we shouldn't underestimate the drag that's going to create.
All right, let's pivot from there. But let's keep that idea of resilience and supply chains in mind. We're shifting from jobs to inflation, but through a really surprising lens, global spices.
This was a fascinating piece of research.
It really was.
Yeah.
So it used specific commodities. We're talking cinnamon, cloves, ginger, nutmeg, allspice.
Right.
And it used them as this, clean window into how inflation actually works.
And the reason is because they all come from just a few places. Vietnam, Indonesia, India. So they're super concentrated geographically.
Which means they should be really sensitive to things like tariffs.
Exactly. The textbook theory says you slap a tariff on these things, and boom, the cost gets passed right to the consumer.
But that's not what happened.
Not at all. The research showed that importers just adapted. Instead of just passing on the cost, you had smaller players, for example. They started mixing new blends to use less of the high tariff stuff. Or they found new places to source from.
And the big companies.
The big companies just leaned on their stockpiles. They used their balance sheets to absorb the shock and delay any price hikes.
So this is the aha moment, right? The real price pressure, the thing that eventually drove costs up.
It wasn't the tariffs.
No. It was things they couldn't control. Weather shocks, disease cycles hitting the crops.
Right. And that's the big takeaway. Pricing power in today's world depends way more on supply resilience and, climate volatility than it does on tax policy.
And that idea extends out to food, to metals.
And definitely to semiconductors, which is where we're headed next.
Okay, let's jump there. The tech story that is just dominating the market, the AI compute cycle.
Sucking all the oxygen out of the room.
It really is. And this is where that theme of infrastructure resilience becomes, almost existential. First, we have to get our heads around the scale of this, the exponential nature of AI workloads.
Let's try to break it down. AI models process information in these little chunks called tokens. Think of a token as like a piece of a word.
Okay.
So one of the sources we looked at had this incredible multiplier effect, a single simple prompt of 150 tokens. But that's you asking the AI a
Yeah.
basic question.
Yeah.
That can explode into 53,000 tokens of computational output just for the model to generate the answer.
53,000 from 150.
And that's not even the whole story. That's just the output. It doesn't count the what they call the intermediary thinking inside the model, which can add another 3 or 4 times multiplier on top of that.
So that's why AI systems just consume compute at this insane rate. It's so much faster than how a human consumes content.
Absolutely. And that's why when you hear analysts say the demand for NVIDIA's chips has no ceiling, they're not exaggerating. That's the math behind it.
But of course, that kind of demand, all focused on one supplier, that creates massive concentration
It's a
risk.
huge risk.
And it's fueling this strategic tension among the biggest buyers, the hyperscalers. So Amazon Web Services, Microsoft Azure, Google Cloud,
They have to be getting nervous.
they are. And they're actively exploring alternatives. The big question is, is the whole pie growing so fast that everyone just wins? Or is this the start of a real competitive fight?
What's really fascinating is how they're responding. It's all about creating optionality.
Hedging their bets.
Exactly. It's the same behavior we saw in the spice market, just on a, multi-billion-dollar scale. Look at the situation with Meta and Alphabet. Sources are reporting that Meta is exploring using Alphabet's own in-house AI chips, their TPUs.
Wait, Meta using chips from a direct competitor? Google? That seems weird. If it's just about getting the best performance.
But that's the critical point. It's not just about performance. The story is explicitly about supply chain hedging.
Oh, plan B.
A plan B and a plan C.
Yeah.
Meta needs to know that if there's a supply shock, or if NVIDIA decides to really crank up prices, they have another viable option to turn to. It mitigates their risk.
And just having that option, even if they don't fully switch over, that reduces NVIDIA's pricing power.
It absolutely does. It puts a check on their leverage, even if overall demand keeps soaring.
So is this the start of a real multi-vendor landscape for AI chips, with AMD and others really competing
Or is it just a very expensive, very public negotiation tactic?
to get better terms from the leader?
I think the sources suggest it's a bit of both, but the hedging is what's driving the action right now.
So let's bring this all home. What does this mean for, the average consumer and the average business, people far away from these data centers? On the consumer side, we're finally seeing it. Retailers like Best Buy are talking about the start of the AI replacement cycle.
It makes perfect sense.
It does. All that hardware people bought during the pandemic in 2020.
The laptops, the TVs.
Yeah, they're all hitting that 5-year expiry window now, and it's happening right as these new, powerful, AI-enabled devices are hitting the shelves.
It's the perfect storm for an upgrade cycle.
And the data shows computing categories are already re-accelerating. So much for the Best Buy is dying thesis,
And then you have the enterprise side. Take a company like Zoom.
which everyone just thinks of as a pandemic video app.
Right. But they've quietly pivoted. They've gone from a pandemic sprint to what you could call an enterprise marathon. They're not just a video platform anymore. They're positioning themselves as this whole customer service plus AI workflow layer.
And is it working?
The numbers say yes. Their large customer revenue is accelerating, and churn is near record lows.
Right.
The key is their AI Companion 3.0. It integrates AI right into sales flows, support, scheduling. It makes them so much stickier.
It raises the barrier to entry.
Much higher than just competing on, cheap video calls.
So that brings our deep dive to a close. To sum it up for you, we've gone from a cooling labor market that's pushing the Fed toward rate cuts,
All the way through to understanding that real inflation drivers are things like climate and supply chain vulnerability, not just policy.
and into this explosive but also really fragile world of AI compute demand.
And if you connect it all, the big theme is resilience. The whole economic landscape is pivoting on the resilience of critical infrastructure.
Whether that's a spice supply chain,
Or a hyperscaler's ability to get chips from more than one place. Or even a company like Zoom building an indispensable AI layer.
and that idea, infrastructure resilience, leads us to a final thought for you to chew on. A risk that kind of hides below the surface.
Yeah, we have to mention the recent outage at the CME, the Chicago Mercantile Exchange.
One of the most critical financial clearing venues in the world.
And that downtime, even though it was brief, it raises some really serious questions about redundancy and resilience across our entire financial plumbing.
It's a reminder that the very foundation of the system, the part that clears trillions of dollars,
Is still a key and often overlooked source of systemic risk.
and a shock there would affect everything we've talked about today. That's where we should all be focusing our critical thinking next. Thank you for joining us for this deep dive. Keep digging into your own sources. We'll catch you next time.